Hello and welcome back to Geopolitics Worldwide. China, the second most populous country in the world, is located in Asia and shares land borders with 14 nations. Its diverse landscape includes significant natural features like the world's third longest river, the Yangtze, and more than half of the fifth largest desert, the Gobi Desert. However, one of the most significant and intriguing aspects of China's geography is that 94% of its population of 1.4 billion residents live in the eastern part of the country, which comprises over 43% of its total land area. This distribution has profound implications for the nation's economy and development. For decades, China was seen as an economic powerhouse. After 40 years of rapid growth, the country surged to become the second largest economy in the world. However, recent years have been a stark reversal of fortunes, with China now facing a potential economic crisis. Sluggish GDP growth, a drop in consumer confidence, and a collapsing property market are among the factors creating some of the worst economic conditions China has experienced in 70 years. Compounding these issues is the country's debt, which reached a record-breaking 288% of GDP in 2023. This indicates severe financial strain that could further destabilize China's already fragile economy. China's economic troubles are not limited to its borders. They have global implications. The country is a top trading partner for more than 120 countries worldwide, and its economic collapse would send shockwaves to the international markets, affecting everything from commodity prices to supply chains. To fully grasp the potential fallout, it's important to examine the various interconnected factors driving China's economic downturn. A significant contributor to China's current crisis is its real estate sector, which has historically been a key driver of growth. Real estate accounts for about 30% of China's GDP, much higher than the 15% contribution from real estate in the US. China's rapid urbanization over the past few decades saw the urban population rise from 36% to 2000 to over 65% by 2023. This led to a housing boom, with developers taking on a significant debt to build massive number of residential units. However, recent data indicates that this property bubble has burst. Since its peak before the COVID-19 pandemic, China's real estate market has been in sharp decline. Sales have fallen by a third, and new construction is down by 60%. In the first 5 months of 2024, housing investment plummeted by 10.2% compared to the previous year, representing one of the worst property market crashes in decades. An estimated 60 to 80 million apartments remain empty, a result of excessive overbuilding during the boom years. In China's 70 major cities, home prices have fallen by 7.5% year on year, the largest decline on record. This is more than just a temporary setback, too. It signals a long-term downturn that could severely undermine the broader Chinese economy. The collapse of major developers like Evergrande has only worsened the situation, leading to widespread defaults and raising concerns about a ripple effect that could destabilize the financial system. The real estate crisis has also impacted local government finances, as local governments in China heavily rely on land sales for revenue, with sales accounting for over a third of their income. With property values plummeting and land sales drying up, local governments are now facing the prospect of defaulting on their debts, which are estimated to range between 7 trillion and 11 trillion. This financial strain is forcing local authorities to cut back on infrastructure projects and social services, further dampening economic activity. The real estate crisis exposes a deeper issue within China's economic structure, a fundamental imbalance between production and consumption. For decades, China's economic model has prioritized industrial production and exports, propelling it to become the world's largest manufacturing hub. However, this strategy has created structural overcapacity, particularly in sectors like raw materials and emerging technologies. Factories and production facilities that were built to meet ambitious growth targets now operate below capacity or lie idle. This overcapacity creates a vicious cycle, as it depresses wages, reduces consumer spending, and further exacerbates economic imbalances. One key metric that illustrates this issue is China's consumption to GDP ratio, which is less than 40%. In contrast, consumption accounts for around 70% of GDP in the United States. This disparity highlights how China's economy remains skewed toward production rather than domestic consumption. Overcapacity has also led to price wars across industries, with companies slashing prices to maintain market share, sometimes selling at a loss. This deflationary pressure makes debt repayments more difficult and discourages consumer spending as people expect prices to fall further. China's investment-driven growth model, characterized by an investment to GDP ratio of 40% to 45%, is also unsustainable. This far exceeds the global average of 20% to 25%, and the U.S. investment makes up only about 15% of GDP. While this investment-led approach spurred rapid growth in the past, the country is now saturated with physical assets like roads, bridges, and factories that are underutilized. These sunk costs fail to generate proportional economic value, further contributing to China's economic slowdown. The Chinese government has attempted to stimulate domestic consumptions through various measures, including subsidies and incentives for consumer goods, but these efforts have largely fallen short. The fundamental issues remain. China produces far more than its domestic market can absorb, and global demand cannot fill the gap. Complicating matters further are China's demographic challenges. After a year of the one-child policy, China's population is now aging and shrinking, which means the domestic consumer base is not growing fast enough to absorb the excess production. Additionally, the aging population is putting increased pressure on healthcare costs and shrinking the workforce, further limiting economic growth. Another factor straining China's economy is its energy situation. As the world's largest energy consumer, China is highly vulnerable to fluctuations in energy prices. Despite being the largest producer of coal, China has historically relied on imports to meet its energy needs. However, diplomatic tensions with Australia led to a coal embargo, limiting China's access to one of its major suppliers and forcing the country to seek more expensive alternatives. This has driven up costs for businesses, particularly in energy-intensive industries that form the backbone of China's manufacturing sector. The Chinese government's response to this crisis has been cautious. The People's Bank of China has cut interest rates to inject liquidity into the economy, and there has been targeted support for the real estate sector, including relaxed restrictions on homing purchases and lower mortgage rates in certain cities. However, these measures have not addressed the structural issues that underpin the economic slowdown. China's leaders are wary of implementing sweeping stimulus measures due to the already alarming levels of debt in the economy. This has resulted in what many economists describe as policy paralysis, where the fear of exacerbating problems has led to insufficient action. One potential strategy to address the economic crisis is to devalue the Chinese yuan. A weaker yuan would make Chinese goods more competitive in international markets and could inflate away some of the country's debt. However, devaluation comes with significant risks, including potential capital outflows and accusations of currency manipulation from trading partners, which could further escalate trade tensions. Compounding the economic issue is China's increasing authoritarianism under Xi Jinping. The government's tightening control over both the economy and society has stifled the innovation and entrepreneurship necessary for growth. Regulatory scrutiny and interventions in private enterprises have created uncertainty, deterring both domestic and foreign investment. Moreover, the government's response to social issues such as rising unemployment, particularly among youth, has added to the overall economic uncertainty. Youth unemployment reached a record high of 21.3% in June 2023 before the government stopped publishing these figures, reflecting a growing concern over social discontent. The global implications of China's economic crisis are profound. As China contributes to more than a third of global economic growth, a significant slowdown could reduce global demand for commodities and negatively impact economies that rely on trade with China. The world is watching closely as China navigates one of the most precarious economic periods in its modern history.